Hello everyone, welcome to my channel. This presentation, I'm going to explain about the future trading, futures contracts trading. So before going to the details, a disclaimer that the information contained in this presentation is for information or education purpose only and is not intended to invest advice. I would request all the investors to have proper research or consult authorized financial advisor before making an investment decision. The information does not take into account any individual investment objectives or financial position and particular investment needs. While reasonable care has been taken in producing this information, changes in circumstances may occur at any time and may impact on the accuracy of the information. So we have taken the hypothetical examples, but that doesn't mean those are the accurate. The data may change in future. So in this video I'm going to give the details about the derivative contracts, introduction to future contract, the features of a future contract, steps involved in trading futures, futures contracts, payoff profiles and different types of margin requirements, settlement price for normal days and settlement date, Securities Transaction Tax, adjustments of corporate actions, closing out of future positions, and accounting for future contracts. These are the topics I am covering in this presentation. So let us start with the derivatives. So basically, futures are derivative product. If we define broadly, derivatives are four types: futures, options, swaps, and forwards. Financial derivatives have earned a well-deserved, extremely significant place among all the financial instruments due to innovation and revolutionized the landscape. Derivatives are specific types of instrument that derive their value over time from the performance of an underlying asset. The underlying asset could be equity, index, bonds, commodities. Derivatives are tools for managing risk. Basically, the derivatives used to reduce the risk. Derivatives provide an opportunity to transfer risk from one to another. India is one of the most successful developing country in terms of vibrant market for exchange traded derivatives. The equity derivatives market is playing a major role in shaping price discovery. Volatility in financial asset prices, integration of financial market internationally, sophisticated risk management tools, innovations in financial engineering and choices at risk management strategies have been driving the growth of financial derivatives worldwide. So derivatives can be traded in two ways, off the exchange and within the exchange. If the contracts are based on exchange terms and conditions, those are the exchange traded derivatives, and they are the standardized contracts traded on an recognized exchange, the counterparties being the holder and the exchange. The contract terms are non-negotiable and their prices are publicly available. Each and every terms are predefined by the exchange, and in exchange traded contract, the counterparty risk is zero because exchange will take care of everything. So the counterparty risk is nil. And the second is the OTC contracts. These are in the OTC contract, the terms are defined based on the buyer and seller. So each type of contract, based on their requirement, they will define and they will agree the contracts. As a result, OTC derivatives are more illiquid. Examples are forward contracts and swap contracts. So the derivative market has existed in India since centuries as a result of the need for both users and producers of natural resources to hedge against price fluctuations in the underlying commodities. Derivatives are an innovation that has redefined the financial service industry, and it has assumed a very significant place in the capital markets. Investors will find that there are lots of opportunities to make money once they understand the concept of derivatives and its applications. Derivatives are financial contracts whose value price is depending on the underlying asset. Here the underlying assets uh, maybe index, equity, bonds, currency, commodities, lot many are available. So ways derivatives are used. Basically, derivatives the main purpose is to hedge risk and speculation and lock an arbitrage profit, to change the nature of liability, to change the nature of an investment without incurring the cost of selling one portfolio and buying another. So these first three we called as they are the major players in the financial derivatives trading, that is hedgers, speculators and arbitrators. Fourth one is to change the nature of liability. Basically, if our portfolio is showing negative by taking a reverse trade in the features or options, so then we can reduce the nature of the liability, like the loss. Or if our portfolio is in loss, by taking a different trade, we can reduce that loss, or we can make it zero, to change the nature of an investment without incurring the cost of selling one portfolio and buying another. So if we have we have a 10 lakh worth of portfolio, and we are expecting a fall in the market, a short term fall. So in those situations, it is not advisable to sell all the portfolio and buy another portfolio after some time, because we don't know how the market behave when it really falls, and after that how these stocks are impacted. So what we can do is we can simply hedge the position with shorting the index futures or shorting other securities. And when the market really reach the low point, then we can close the hedge positions, and we can continue the portfolio as it is without changing the portfolio structure. And when it comes to the first three, hedgers, arbitrators and speculators, so basically there are three major players in financial derivatives trading. These are the three: hedgers, speculators and arbitrators. Hedgers are traders who use derivatives to reduce the risk that they face from potential movements in the market variable, and they want to avoid exposure to adverse movements in the price of an asset. Majority of the participants in the derivative market belong to this category. Hedgers are traders who wish to protect themselves from the risk involved in price movements. So hedging is buying or selling future contracts as a temporary substitute for buying or selling the commodity or any stock at a later date in the cash market. The second one is speculators. Basically, speculators are traders who buy or sell the asset only to sell or buy them back profitably at a later point in time. They want to assume risk. They use derivatives to bet on the future direction of the price of an asset and take a position in order to make a quick profit. So they do their own research, and they'll come to a conclusion which direction market is moving. Based on that, they will take the position, and they will try to benefit out of those positions if the if the price moves as per their expectation. So speculators are people who analyze and forecast future price movements, trading contracts with the hope of making a profit. Speculators put their money at a risk and must be prepared to accept outright losses in the future market. These are the speculators. Most of the futures and options traders, retail, at least in retail traders, they're like speculators. They assume the price movements and they will trade accordingly. And the third one is arbitrators. Arbitrators are traders who simultaneously buy and sell the same or different but related product assets in an effort to profit from unrealistic price differentials. A best example is if ABC stock is quoting at around 1,000 rupees, 1,000 in cash market, and if it is trading 15 rupees discount or 15 rupees premium, assume it is trading into 15 rupees premium. So what arbitrator can do is he will buy the stock in cash market and he will sell the future contract. So whatever the 15 rupees difference at the expiry date, he will benefit out of that. That is the way how they will plan. And The other thing is, suppose in cash market, if a security is trading in both National Stock Exchange and Bombay Stock Exchange, that is NSE and BSE. Obviously, there could be some price differences between those stock exchanges. A few people are there where they can benefit out of that, buying one exchange and selling. So, uh, wherever the price is low in that exchange, they will buy, and which exchange is showing high price, they can sell in the same time. So the difference will be locked, and they will benefit out of that. So in the future contracts and derivatives, this is the one way where people can benefit out of arbitraging. They attempts to make profit by locking a riskless trading by simultaneously entering into transactions in two or more markets. They try to earn riskless profit from discrepancies between futures and spot prices and among different future prices. So at any point of time, the future price and cash price should always show either discount or premium. So they want to benefit out of that. So these are the three major players in the derivatives market, in any exchange. So futures contract. A future contract is an agreement to buy, that is called long, or sell, which we call as short, something in the future at an agreed upon price, that is the future price. Futures contract is an agreement between two parties to buy or sell a specified quantity of an asset at a specified price and at a specified time and place. If it is commodities, then and they are on delivery based, then the exchange will define the terms and conditions with the place of delivery also. Future contracts are normally traded on an exchange which sets the certain standardized norms for trading in future contracts. Everything about a future contract is standardized except its price, because price is a variable thing. It's needs to be agreed between the buyer and seller. All of the terms under which the commodity or product to be transferred as established before active trading begins. So neither side is hampered by ambiguity. The price for a future contract is what is determined or on the electronic trading system of the future exchange. So we can see the price in the trading terminal. A future contract is a legally binding agreement to take or make a delivery of buy or sell a specified amount of an asset at a certain time in the future for a price that is agreed today. So in future contracts, we agree the price today and we'll wait till the expiry date to accept that contract. Initially, we agreed that contract, and on settlement date, based on the price, the closing price, the exchange will decide the profit and loss. They will calculate the profit and loss based on the closing price, based on the settlement price. Then the accounting will be taken care. The buyer enters into an obligation to pay and the seller is obligated to sell on a specific date. Exchange traded features are standardized in terms of size, quantity, grade, and time, so that each contract traded on an exchange has the same specifications. So this allows for a secondary market to exist where a futures contract that is purchased can be sold to someone else. Futures are in effect substitutes or synthetic versions of an underlying asset from which they derive their value. More or less, the price movements between a future contract and a spot price, future price and spot price, the price movement is more or less same. Maybe the futures may trade either discount or premium, but the movements are more or less same. A futures price for a particular contract is the price at which you agree to buy or sell. It is determined by supply and demand in the same way as the spot price. So the price of the future contract is a variable thing. Based on the demand and supply, it will be varied. So the future date is called the delivery date, and the settlement price, there is a specific mechanism to find out the settlement price. I will discuss that in later slides. The preset price is called the future price. The price of the underlying asset on the delivery date is called the settlement price. The futures price naturally converges towards the settlement price on the delivery date. So the futures contract standardized terms, how the exchanges are standardizing the terms. Uh, Broadly, I have taken 10 things standard size: quantity, quality, expiration month, delivery terms, delivery differentials, delivery dates. If it is uh, commodities, then we need the details about the delivery, quality, quantity of delivery, and what are the different dates and location, minimum price fluctuations, delivery price limits, and trading days and hours. So every future contracts will have its own discrete specifications, standardized terms being the key to listed future contracts. The same specifications applies equally to all the market users. So if they define standard terms for a contract, it will be applicable to everyone. Uh, Basically, the unit of trading means the specified type and the amount of underlying product which makes up the basis of the contract. Quoted currency, it is a INR in any of the exchanges like NSE and BSE. It is INR because these are Indian exchanges. Base currency is INR. Delivery month. Uh, The month sometimes called the delivery period or expiry month, when the contract will be finally settled by physical tender or the payment or receipt of cash against the final settlement price. A delivery day, if it is a commodity contract, the delivery day is the final day when future contracts are settled by the receipt or tender of the physical underlying product or exchange of the cash. The quotation is the way in which the price of a contract is expressed. So it's a 5 paisa movement every time. So I'll give different features of different types of features. Basically, equity feature, index feature, commodity feature, interest rate features, bond features. These are the different types of feature contracts. Uh, Different physical asset, financial assets. Based on the assets, so we divide them. If it is the shares, then we can call them equity features. If the contract is based on the index, so we call them index features. And this contract, the financial asset is related to commodities, we call them as commodity contracts. So equity index features are based on the value of an underlying stock index such as Nifty or Bank Nifty. Delivery is fulfilled by the payment or receipt of cash against the settlement price. Equity features are based on individual shares. In most cases, delivery is fulfilled by the payment or receipt of cash against the settlement price. In some exchanges, there are physical settlement and stocks are also available, but in India, it is purely cash settlement. Commodity features are generally used by participants that are involved in the physical commodity market. When financial institutions are allowed to use commodity derivatives, careful controls must be in place because of the implication of physical delivery. And in commodities, again, agriculture, metals, and energy, there are three broad categories. Agriculture are the features on agriculture products such as wheat, barley, corn, etc. Delivery dates of these products revolve around the harvest time. Basically, the based on the harvest time, the delivery dates will be decided. There are normally physical delivery contracts that call for certain weight, origin, and grade of agriculture product to fulfill the contract. In case of those commodities that are easily perishable, delivery must be carefully managed because these are perishable. And the other type is metals. These are features on precious metals such as gold, platinum, and silver, and also on base metals such as lead, copper, tin, aluminum, and zinc. They are physically deliverable contracts of certain origins, grades, and quantities of each metal. Metals are sometimes referred as the hard commodities. The other one is energy, gas, crude, gas, coal. These are called as energy metals. Uh, these are features and options on energy products such as crude oil, heating oil, gas oil, and coal. So basically these are different derivatives on different financial or real estate assets. So features of futures contract. Futures are traded only on organized exchange. Futures contract required to have standard contract terms. Futures exchange has associated with the clearing house. Futures trading required margin payment and daily settlement. Futures position can be closed easily. Future markets are regulated by regulator that is like SEBI. The future contract executed on expiry date. The futures are the futures price are expressed in currency units with a minimum price movement called a tick size. So its features are these are the traded contracts within an organized exchange. Unlike the forwards, the future contracts are standardized contracts and are traded on stock exchanges. It is standardized contract with a standard underlying instrument, a standard quantity and quality of the underlying instrument that can be delivered in a standard time for such settlement transactions. If the existence of a regulatory authority is there, SEBI will monitor each and everything and they will take necessary steps if anything they suspect. And to trade in future contract, margin requirements are there. The initial margin and mark to market, there is a standard risk measurement system. So based on that, the exchanges as well as regulators will monitor each and everything. So these are the leveraged positions. Only the margin is required for trading in future contract. We need not pay whole amount. And the other benefit is without holding a security, you can short in the futures market. So both buy long and short you can trade, and even you can trade index contracts. So the with the future contract you can hedge arbitrage the positions. We'll give a we can discuss in an example. Suppose when you are dealing in February 2019 futures of Infosys, the minimum market lot is 1200. So market lot is 1200 shares for Infosys. The contract will the expiry date for this February contract is 28th February 2019. The price is, for example, uh, in the Indian market, the price is quoted per share. The tick size is 5 paise per share. The contract would be settled in cash and closing price in cash market on the expiry date would be the settlement price. So these are the basic terms and features of future contract. And another example, suppose on 1st February, Mr. A enters into futures contract to purchase 500 equity shares of ABC Limited at an agreed price of 100 in February. If on maturity date the price of equity stock rises to 110, Mr. A will receive 20 rupees as a profit. And if the price of share falls to 90, Mr. A will pay 10 rupees because of the loss. The futures are settled only by the difference between the strike price and the market price as on maturity date. In the both examples, the quantity size, everything is defined. In for example, first example, the quantity is defined and the expiry date is defined. The tick size is defined. Everything. So standardization of the contract and exchange will take care of the daily profit and loss of calculation, and they will levy to the investor on daily basis. So I'll give the examples of the contract specification for stock futures. So here the contract period is 1 to 3 months. Every future contract we have a 3 months period. Contracts are available. The current month, next month, and the 4 month contracts. The tick size is 5 paise, and price quotation is in INR, that is Indian rupees. The base currency. Trading hours are 9:15 a.m. to 3:30 p.m. Last trading expiry day is last Thursday of the contract month. If the last Thursday is trading holiday, then previous business day is the expiry date for those contracts. Final settlement would be the cash settlement in NS and BSE on the last trading day. The closing value of the underlying stock is the final settlement price of the expiring futures contract. So the final settlement price, how they arrive, I will discuss in the coming chapters, coming slides. So future contracts have a minimum of 3-month trading cycle, the near month, the next month, and the far month. New contracts are introduced on the trading day following the expiry of near month contracts. The new contracts are introduced for the 3-month duration. This way, at any point in time, there will be 3 contracts available for trading in market for each security. That is one near month, one mid month, and one far month duration. Futures contract expire on the last Thursday of the expiry month. If the last Thursday is a trading holiday, the contracts expire on the previous trading day. So, how to trade in futures market? So here when we are discussing about quantity, there is always a question: how many contracts I can trade at a time? So there is the applicable quantity freeze limit shall be based on the level of underlying. That they always define the exchange as well as the regulators define the quantity freeze. I'll give an example for index. If the index price is below 5,750, the quantity you can trade in a single trade is 15,000. The index level is 5,751 to 8,625. The quantity freeze limit is 10,000. From 8,626 to 11,500, the quantity freeze limit is 7,500. 11,500 to 17,250, and the quantity freeze is 5,000. If the index level is greater than 17,250, the quantity freeze limit is 2,500. So here, let me explain with an example. So Nifty is trading at around 11,000 levels. So it is in between 8,626 and 11,500. So in a single trade, you can put 7,500 quantity in a single trade. And when it comes to Bank Nifty, it is trading around 27,500 level. So about 17,250 level. So in a single trade, you can put 2,500 quantity. That is the quantity limit. So steps involved in trading futures. So it's general thing. We need to open a trading account with an exchange through a broker. So we have to maintain, we have to deposit some amount as initial margin to enter a trade. From there, we will get an access to the trading system, trading terminal. You can trade online, or we can call the broker and input our orders. So sign up the client agreement from form and risk disclosure document provided to you by the broker. A deposit upfront initial margin. You can pay initial margin in. There is another concept as collateral. You need not always pay the cash as a margin. So if you have securities, you can use them as a collateral, but exchange will decide which securities they will accept as a collateral and the haircut on those securities. Few securities 25% haircut to few securities 30%, few securities 50% or 40% based on the exchange rules and regulations. They will accept the securities. We can use the non-cash margin as a securities collateral. This is an arrangement between the investor and the broker. If they agree, then they can take it. However, the mark-to-market loss has to be settled in cash only. So this security collateral margin is for initial margin purpose, not for mark-to-market. So we'll discuss the mark-to-market and initial margin in coming sessions. Majority of the trading members are providing the online trading facility to trade in the future and option contract. So you need not always call the broker and check the prices. You can check with even mobile. We can check it. You are required to open an account with one of the trading members and complete the related formalities, which include signing of my member consent agreement, consent registration form, and disclosure document. The trading member will allot you a unique client identification number. So once you submitted your documents, they'll create an account and they will allot you a unique identification number. To begin trading, you must deposit cash or collateral margin. So the futures and options trading system provides a fully automated trading environment for a screen-based online monitoring and surveillance mechanism. The system supports an order-driven market and provides complete transparency of trading operations. Orders as and when they are received, the first time stamped and then immediately processed for a potential match. If the match is not found, then the orders are stored in the different books. Basically, the orders is matched based on best price and the best time. So price and time priority. We'll discuss about the different types of orders. So every order must include the details of the contract and the details of the trade. So whether the trader wants to buy or sell, is it a buy trade or sell trade? So the name of the contract, whether it's a equity contract, means the underlying security. The delivery month, which month we want to trade, current month, mid month, or for month, and the number of contracts, how many contracts you want to trade, the exchange on which they want to trade. If the same features are same underlying asset is in multiple exchanges, in which exchange we want to trade, that is we need to define the exchange on which they trade. It's a NSE or BSE in Indian scenario. Day order or good till cancelled order, but because good till cancelled, we need to see whether it is applicable or not. Is it a day order? Is it a immediate order? Is it a stop loss order? We need to define the kind of order. Limit order, if limit order, then specify the limit price. So we'll discuss about the different types of orders. Understanding the types of orders and when to place them is one of the investor's greatest safeguard. When it comes to the order matching rules, the best buy order will match with the best sell order. An order may match partially with another order, resulting in multiple trades. Because just for an example, if I want to buy 1,000 Infosys shares, once I update in the system, it is not expected to trade all the 1,000 shares in one trade, because the sellers also should be in the same quantities. So if there are multiple sellers in the same price, you'll get multiple trades, you can see in the contract, the agreement, how it is traded. For order matching, best buy order is the one with the highest price and the best sell order is one with the lowest trade. This is because the computer views all buy orders available from the point of view of a seller and all sell orders from the point of view of the buyer in the market. So if all buy orders available in the market at any point of time, a seller would obviously like to sell at the highest possible buy price that is offered. And so the best buy order is the order with the highest price and vice versa. Members can proactively enter orders in the system, which will be displayed in the system till the full quantity is matched by one or more of counter orders and result into orders. Alternately, members may be reactive and put in orders that match with existing orders in the system. Orders lying unmatched in the system are passive orders. We call them as a passive order. And orders that come into matching the existing orders are called active orders. Orders are always matched and at the passive order price. So order conditions, basically a trading member can enter various types of orders depending upon their requirements. These conditions are broadly classified into two categories: time related orders or time related conditions, or price related conditions. So price related means at what price they want to trade, or time related means certain times but most of the conditions are price related, and the time related and price related conditions we can define. These are the broader ways. And when it comes to time conditions, there are two types of orders: day order and IOC order. These two comes under time conditions. The day order is, as the name suggests, it is an order which is valid for the day on which it is entered. If the order is not matched during the day, the order gets cancelled automatically at the end of the trading day. The exchange will take care of all the pending orders, and they'll automatically close out those positions post the market close. So IOC order is, it allows a trading member to buy or sell a security as soon as the order is released into the market, failing which the order will be removed from the market. So partial match is possible for the orders, and the unmatched portion of the order is cancelled immediately. So here the thing is, we have to check whether the order is executed or not. If any order is fully executed or not, if any pending trade, then we have to re-enter the order. So the other type, the based on the price condition, limit order, market order, stop loss order, and within the stop loss we can see trailing stop loss orders. So limit orders, basically, if you don't like being left to the mercy of the market, when your stop order become a market order, you can use a limit order. Sometimes it's called a price order. Limit orders are used to buy or sell at specific price levels. Buy limit orders are placed below the going market price, and they can only be filled at or below the limit price. Sell limit orders are placed above the current market price and can only be filled on at or above the limit price. Keep in mind that orders that others other than straight market orders have a lower priority, because the market orders always will have the higher priority. They will execute immediately. In fast moving markets, you may not get filled these kind of limit orders, because if the price falls suddenly, then these kind of orders will not be executed. An order that allows the price to be specified while entering the order into a system, that is limit order. So the second one is market order, an order to buy or sell securities at the best price obtained at the time of entering the order. Market orders are orders to buy or sell at the current price as quickly as possible. These are the first orders to be executed, because they can be filled at any price. Use them when you want to get into or out of the market quickly. When markets are choppy with a lot of volatility and low volume, you may not want to use a market order, because you don't know when or at what price it will be filled. So market, the price is falling suddenly, then it will be very difficult to identify the price, which price you want to trade. The sudden spike. So the third one is stop loss order. We can have stop orders. The stop loss order is the one that allows the trading member to place an order which gets activated only when the market price of the relevant security reaches a threshold price. Until then, the order does not enter into the market. So it's a stop loss order always. It's a in a special situations, you may want to use stop orders. You place buy stops above the market if you are bullish on prices, or sell stops below the market if you are bearish. Stop orders become market orders when the price trades at or better than the stop price. Once your stop orders becomes market orders, you take on all the risks of a regular market order. So once the stop order become the market orders, it will become a regular market order. Price could spike up or down to hit your stop and then move against you. By the time your order gets filled, it is way above or below the price you were hoping for. That is the risk of market orders. A sell order in the stop loss book gets triggered when the last triggered price in the normal market reaches or falls below the trigger price of the order. A buy order in the stop loss book gets triggered when the last traded price in the normal market reaches or exceed the trigger price of the order. Uh, Here there is an example. If for a stop loss buy order the trigger is 93, the immediate price is 95, and the market price is 90. Then this order is released into the system once the market price reaches or exceed 93. This order is added to the regular lot book with time of triggering as the timestamp as a limit order of 95. So we can see the best 5 orders in the system, or you can see the in the order book in our system. Stop orders are often used to close out the protected profitable positions. They are called trailing stops. As your long futures positions gain value, you place sell stops just below them. You continuously move the stop up as your trade becomes more profitable. If the market moves against you, your sell stops are hit. They become market orders and you offset your position. This is referred to as being stopped out of the market. So always you need to change the trailing stop loss as long as the price is moving as per your expectations. If you are short futures, so you can do just the opposite with your buy stops. Just place your stop orders above your position. You wait for the market to pick off your stops and close your positions at a profit. Placing a stop takes some skills and experience. If you place it too close to your position, a slight move in the wrong direction removes you permanently from the market. If you put it too far from your position, you can give up too much of your profit before your stop is hit. So these are the two things we need to always think. If your stop price is too close to your current market price, a sudden spike will hit the price. If it is too far, then even though if the market is against your justification, then it will take time to hit and the loss would be very huge. So you need to have proper strategy to identify the stop loss positions and trailing stop loss. So future contract payoff. So this is for long positions. So this is our break even point. Above the break even it would be the profit, below the break even it will always be loss. This is a profit and loss chart for future long futures. And short side, price is falling, then your profit will be more. If price is going up, you will be in loss. So the long profit if the next day's future price exceed the original future price. The short profit if the next day's futures price is below the original price. So when the price is falling, you will be in profit. Price is up. For long futures, the market should go up, and for short futures, market should go down. The price go down, then you will be benefited. So settlement price. How the settlement price is arrived. Trading and settlement in future contracts. We need to understand a little bit more because the trading in future contracts can be affected on a daily basis, and one can enter into the trading scenario as a buyer or seller through the terminals of approved stockbrokers. Whether to start as a buyer or seller depends on one's perspective about the value of the underlying asset. So the market movements and the analysis of the trader, they can enter either buy side or sell side. At any point of time, there are 3 series which are available in the future market as a 3 future contracts available market. Based on that, you can trade. Suppose this month, nowadays you can predict monthly, even monthly targets also. So which month contract we have to enter? After entering into a future contract, the trader can keep his position open till the day of settlement, normally the last Thursday of the month, or the position could be closed out by offering an opposite transaction, a sell against the buy or a buy against the sell. So long as the position is open, that is called as an open position, the mark to market margins will be levied on open positions on a daily based every day at the daily settlement price. The closing value of the daily settlement price is the closing value of the security on that day, and the difference will be credited or debited to the trader's account. The position will be brought forward to the next day at a daily settlement price. On the day of settlement, all open contracts for that month will be closed out by the exchange at the settlement price. So here, daily settlement and final settlement, there are two different things. So for the futures contract, daily settlement would be the closing price of future contracts on the trading day. Here the closing price is the last 30 minutes weighted average price. The closing price for a future contract shall be calculated on the basis of the last half an hour weighted average price of the contract. This is for daily settlement. For the final settlement, the closing price would be the relevant underlying index or securities in capital market segment. That is, for example, I will discuss an example. If suppose a person entered into a Reliance future contract for February month, February 2019. The expiry date is February 28th, 2019. So from day 1 to till February 27th closing, the closing price would be the based on the Reliance future contract last 30 minutes weighted average price. That is the closing price to calculate mark to market. And on 28th, after market closing, the final settlement would be calculated based on the Reliance cash price, the spot price, the cash market, the closing price of Reliance shares. The closing price means here the last 30 minutes weighted average price. So that is the way how the settlement price is calculated. So for daily settlement, the 30 minutes, the last half an hour weighted average price of the respective underlying future contract price is the settlement price, and for the final settlement, the respective underlying asset, underlying security last 30 minutes or last half an hour weighted average price in cash market. So daily settlement future market closing price, and final settlement cash market closing price. This is what we need to understand here. So for options also the same thing. So this is about the settlement price. So now the critical topic is the margin requirements. So a margin in the future market is the amount of cash an investor must put upon to the open an account to start trading. This cash amount is the initial margin requirement. It is not a loan. It acts as a down payment on the underlying asset and helps ensure that both parties fulfill their obligations. So before trading, before entering into any contract, the investor should pay the initial margin requirement as per the exchange terms and conditions. The maintenance margin is the minimum amount of equity that must be maintained in a margin account. In the context of this is more of global markets. After an investor has bought securities and margin, the minimum required level of margin is 25%. And total market value of the securities in the margin account. So this maintenance margin will always vary based on the exchanges and the daily movements. Variation margin is the additional funds that the broker may request from a client so that the initial margin requirements of his position keep up with any loss. If the client's equity falls below the initial margin requirements and marked to the closing price at the end of each day, a margin call will be made. So clearing margins are distinct from customer margins that individual buyers and sellers of futures and options contract are required to deposit with brokers. So basically, these are the main initial margin, maintenance margin, variation margin, and clearing margins. So the other things put aside, the initial margin, maintenance margin always hit the customer account because these are the basic requirements the customer needs to always maintain, and if failing to maintain those margins, they'll get a call from broker or exchange is having a right to close out the positions without keeping them for long period. So NSE Clearing has developed a comprehensive risk containment mechanism for the futures and options segment. Futures exchanges required good faith money from counterparts to futures contract to act as a guarantee that each will abide by the terms of the contract. Each futures exchange is responsible for setting the minimum initial margin requirements for their futures contract. So the exchange will decide how much margin needs to maintain on a daily basis. It is not a periodic basis. It is every day they will calculate and they will send the information to the respective clearing members to levy the margin to the respective trading members, that is individual investors accounts. The initial margin is the money a trader must deposit into a trading account, that is margin account, when establishing a futures position. Many futures exchanges establish initial margin requirements by using computer algorithms. The most popular of which is called as SPAN, Standard Portfolio Analysis of Risk. That is the method using by the exchanges. So the most critical component of risk containment mechanism for NSE clearing is the online position monitoring and margining system. The actual margining and position monitoring is done in online on an intraday basis. NSE clearing uses the SPAN, Standard Portfolio Analysis of Risk system, for the purpose of margining, which is a portfolio based system. So SPAN uses historical price data to set initial margin to what is believed to be the worst case one-day price movement. An exchange can change the required margin anytime. Initial margin will increase if price volatility increases or if the price of the underlying commodity rises substantially. So NSE clearing collects the initial margin upfront for all the open positions of a clearing member based on the margin computed by the SPAN system. Initial margin requirements are based on 99% value at risk over a one-day time horizon. However, in the case of futures contract, an index or individual securities, where it may not be possible to collect mark-to-market settlement value before the commencement of trading on the next day, the initial margin is computed over a two-day time horizon, applying the appropriate statistical formula. The methodology for computation of value at risk percentage is as per the recommendations of SEBI from time to time. So SEBI will take care of the margins. The exposure margins, here the exposure margins for options and future contracts index are for index options. Even the margin is required for buying and selling a future contract as well as selling of option contract. So a call, sell, put, sell required option. These options required the margin. So each clearing member is having a right to levy some exposure margin apart from the margin decided by the exchange. So, margin for a common stock, the fraction of the assets cost that must be financed by the purchaser's own funds. The remainder is borrowed from the purchase stockbroker. Margin for futures. So, in the common stock, suppose if a person want to buy 1 lakh worth of stock, he needs to pay 1 lakh worth. There is no other way of buying the stock without paying the amount. But when it comes to futures contracts, a good faith deposit or collateral designed to ensure that the futures traders can pay any losses that may be incurred. Futures margin is not a partial payment for for a purchase. So for future contract, there are 17%, 18%, 20% based on the stock volatility and price movements. The exchange will decide the margin amount that needs to be paid. It is not required to pay 100% of the value of the contract. So a certain portion of the amount we have to pay, and this again the cash margin or cash deposit or collateral deposit is accepted by the exchange. So margin calculation. The span, it is developed by Chicago Mercantile Exchange in 1988. It's a risk-based portfolio approach. There are some risk scenarios. Span features span further uses a standard definition of risk scenarios, price scan range and volatility scan range. Actually, there are 16 scenarios. At each point of time, they will calculate each scenario how the loss is. So these are the scenarios. If underlying price is unchanged and volatility up, underlying price unchanged and volatility down. If underlying price is up by 1/3, price can range and volatility up. So these are the different scenarios, 16 scenarios. So each scenario, uh, the system calculates the risk, that is called in a out of 16 scenarios, wherever the risk is high, they will take that as a margin requirement for that security. So 1/3 price up, 1/3 price down, and price up and volatility up, price down, up and volatility down, price down, volatility up, price down, volatility down. So like there are 16 scenarios. So each scenario, what could be the maximum loss, and out of 16 scenarios, so what is the highest loss. So from there, that will be taken as the margin. If the equity in the account falls to or below the maintenance margin level, additional funds must be deposited to restore the account balance to the initial margin level. So as per the market movements, if the market is against the expectation, then the additional margin is required. So discuss this an example. Suppose the initial margin required to trade one Nifty future contract is assume 90,000 and the maintenance margin level is 75,000. Then an adverse change of rupees 20 will result in a margin call. Because one Nifty future contract over 75 units of Nifty index, a decline 20 unit in the futures price will deplete the equity of a long position by 1500, because 75 is the lot. The trader with loss must then deposit sufficient funds to bring the equity in account back to initial margin. So initial margin 90,000 is required. So if there is any negativity, negative entry posted, then always the investor needs to maintain to bring back the initial margin amount as expected. The margin that is deposited in order to meet margin call is called variation margin. If the trader does not promptly meet the margin call, his broker will liquidate the position. So the broker is always having a right. When we are signing up the agreement documents, that clearly indicate that the broker will have the right to liquidate the position if not required the margin requirements. So Note that once the trader receives a margin call, he must meet the call even if the price has subsequently moved in his favor. Suppose, I'll give an example. Today, someone bought a Nifty contract at 11,050. Future price assumed at 11,050, and end of the day it is closed at 11,000. There is 50 rupees loss in his account. So his buy price is 11,050 and closing price is 11,000. There is a 50 rupees loss in current day trading. So 50 rupees into multiplied by 3,750 rupees loss. So he needs to deposit that amount next day before the market opens. And suppose if the market close about 11,050 on next day, that doesn't mean he is not pay the amount within the market hours. Even though it market up and he's in profit, he needs to pay the previous day's loss as per the rules. For example, here I have given an example. Suppose the future price of Nifty index declines to a level that triggers a margin call on day T. T means trading day, and day T plus 1, trading day plus 1. The trader who is long on Nifty future contract will receive a margin call regardless of the future price of Nifty on day T plus 1. And here, as I explained, if the market is opened around a 50-55 points gap up and he is in position, but he can't say that he need not pay the amount. He should pay the amount based on the requirement. Even if the Nifty future price has substantially rebounded, the trader must still deposit variation margin into his account. Brokers will often set initial and maintenance margin requirements at higher level than the minimum requirements specified by the exchanges. So brokers is having a right to charge a 5% to 10% margin apart from the margins defined by the exchange. Sometimes based on investor behavior, brokers will change this margin and they will levy higher margins. They have the right. Margin requirements also differ for different traders depending on whether the position is part of a spread, a hedge, or a speculative trade. Margin requirements for spreads and hedges are less than those of speculative positions. So here the example is suppose if a person is having one Nifty long and the margin requirement is assumed 90,000. If he buys a put option on Nifty same month contract, his margin will decrease because the combined portfolio risk is less than a single long position. Then he needs to pay less margin. And if a person is long future contract and sold a call option, then the margin will be different. So each and hedge positions based it is calculated on a portfolio overall portfolio. The margin will be differ based on his existing portfolio. The other concept is mark to market margin. So future contracts follow a practice known as mark to market. At the end of each trading day, the exchange sets a settlement price. As we discussed the settlement price based on the day's closing price range for each contract. Each trading account is created or debited based on the day's profit or loss and checked to ensure that the trading account maintains the appropriate margin for all open positions. So here the position in the future contract for each client is marked to market and a daily is a settlement price. This daily settlement price is closing price of the future contract and a trading day. The closing price is that last half an hour weighted average price of the contract and the future contract at the end of each trade day. The profit or loss are computed as the difference between the trade price or the previous day's settlement price, as the case may be. If the person entered a trade in the current day, the buy price and the today's closing price would be the mark to market for today's mark to market calculation, and for next day, today's closing and the next day closing price would be the mark to market difference. After daily settlement, all the open positions are reset to the daily settlement price. So in case of final settlement and the expiry of the future contract, NSE clearing marks all the positions to a final settlement price and the resulting profit and loss settled in cash. The final settlement of the future contract is similar to the daily settlement process except for the method of computation of the final settlement price. As we discussed, for the final settlement, final settlement price would be the underlying asset last half an hour weighted average price in capital market, in cash market segment. The final settlement profit or loss is computed as the difference between the trade price of the previous day's settlement price, as the case may be, and the final settlement price of the relevant future contract. Final settlement loss or profit amount is debited or credited to the relevant member's account and T plus 1 day, that is uh, T plus 1 trading day plus 1 day. So open position, the future contract ceases to exist after their expiration day. So after expiration day, it will be closed out and the uh, after the final day, everything, all the open positions will be closed out by the exchange. So the mark to market is an important safety measure that provides additional protection for you and your broking firm. Combined with other financial safeguards, mark to market is a major benefit of doing business on a regulated exchanges. For example, here I have given an example of taking a oil contract. Consider two counterparties that enter into a future contract for 10 barrels of oil at 100 per barrel with a maturity of 6 months. The value of the future contract is $1,000. At the end of the next trading day, the price of oil is 105 per barrel. At this point, the trader in the long position collects 50 rupees from the trade in the short position. So this is an example how the MTM is calculated and levied. So the entire daily resettlement process is illustrated in the example. Suppose on January 7th, 2009, you bought one Nifty future contract for expiry on 31st January 2019. Suppose you bought the contract at 10 a.m. when the future price is 10,885. The initial margin requirement is 90,000 and that sum of the money is transferred from your cash account to margin account. The settlement price at the close of January is 10,803.45. So that is the futures closing price on that day. So there is a difference of 81 rupees 55 paise, that is the loss. Your account is marked to market and your balance at the close is 883.75. So 83,883 rupees 75 paise, because the 6,116.25 is the loss. The futures price fallen by 81 rupees 55 paise per unit and one contract hour 75 units of Nifty. So for lot size is 75. The loss is 75 multiplied by 81 rupees 55 paise. So 6,116 rupees 25 paise is the loss on the long position. So this is how the mark to market amount is calculated on trading day. So on the from next day onwards, previous closing and the current closing will be taken as the mark to market, and the in between, if a person closed out the position, the selling price and the previous day's closing price will be the difference of selling price and previous day closing price will be the mark to market on closing out position day. And the next is Securities Transaction Tax. So as per the Finance Act 2004 and modified by the Finance Act 2008, STT on the transaction executed on the exchange shall be this is how they are calculating and who is the responsible to pay the STT. Sale of an option in securities. So 0.05% and seller, they will collect from the seller. Sale of an option in securities where the option is exercised. If the option is exercised by a seller, then purchaser is responsible to pay the STT. So we need to be very careful when we are exercising, because the exercise option is having the purchaser, so he wants to close out his position with the exercise option. So purchaser is the beneficiary out of the position, so they'll collect from the purchaser if he execute the exercise option. The sale of a future contract, 0.01% of contract value, and seller is liable to pay, so it will be levied to the seller. So that's why when we are trading options, basically the STT is very huge than your expected amount, because the options you trade with the premiums, but when it comes to the calculation of STT, they'll calculate based on the contract value. Suppose just an example, if Nifty 10,700 call option is uh, suppose Nifty 10,700 call option is trading at 20 rupees, assume. So on the expiry day, Nifty closing price would be around 10,715. So your premium would be 15 rupees. Suppose you bought at 10,700 call at 10 rupees, and the closing price is 15 rupees. So you will get a 5 rupees benefit. But for calculation of STT, your strike price is 10,700 multiplied with 75 would be the quantity, and 0.05% on that value. So that will be your STT. So you have to pay more huge amount on that. So that's why be careful when you are dealing with option contract, because the STT is very huge. So if you are not able to close out your positions, if you close out your positions, premium amount will be the profit you will get. If you are not closing out the positions, you have to pay more STT on the open positions. So this is the procedure adopted by the exchange. STT is applicable on all sell transactions for both futures and option contract. For the purpose of STT, each futures trade is valued at the actual traded price, and option trade is valued at premium if you are selling out the positions. So on this value, the STT rate as prescribed is applied to determine the STT liability. In case of final exercise of an option contract, STT is levied on settlement price on the day of exercise if the option contract is in the money. So in options, if you sold out the position before expiry, then the STT is levied on a premium. If you are not sold out the position, if it is open position and exchange will close out the position, then you have to pay an overall contract value of the option. So that's why you have to end up with paying more amount on that. STT payable by the clearing member is the sum total of STT payable by all the trading members clearing under him. The trading member is liable, is the aggregate STT liable to the client trading through him. So the STT, each contract level, the clearing member will collect from each individual investor level, and the exchange will collect from the clearing member on settlement days based on the settlement day. So for each settlement day, they will collect the bulk amount from the clearing member. So clearing member is responsible to collect from each individual investor. So here exchange is having a right to penalize if not met the requirements. There are basically short reporting of margins in client margin account. See, each and every clearing member has to submit the client margin collection details to the exchange, and every day they have to send the files to respective exchanges. If they are failed to collect the amount from the exchange, from the investor, they have to pay some penalties. Exchange will levy the penalties to the clearing members, and obviously those will be applicable to the individual investor. So short collection of each client, if the short amount is less than 1 lakh and are um, less than 10% of applicable margin, the penalty is 0.5% on the difference amount. If it is equal or 10% of a margin, it is 1%. If short non-collection of margins for a client continues for more than 3 consecutive days, then penalty of 5% of the shortfall amount shall be levied for each day of continued shortfall beyond the third day of shortfall. If short collection or non-collection of margins for a client takes place for more than 5 days in a month, then penalty of 5% of the shortfall amount shall be levied for each day during the month beyond the fifth trading day of the shortfall. If short collection of margin from client is caused due to movement of 3% or more in Nifty 50, close to close, so movement not within the intraday, so previous close to current close, if it is 3% or more on a given day, that is T day, then the penalty for short collection shall be imposed only if the shortfall continues to all to T plus 2 day. So they will execute excess plus 2 days, and after T plus 2, so trading day plus 2 days, if it is continuous, then they will charge the penalties. All instances of non-reporting are treated as 100% short reporting for the purpose of levy of penalty. And the other kind of penalty is market-wide position limit violation. Sometimes we know few securities are on ban period. If anyone trade on those securities, exchange will levy the penalties those persons at the end of each day during which the ban of fresh positions is enforced for any security. When any member or client has increased his existing position or has created a new position in that security, the client or trading members will be subject to a penalty of 1% of the value of increased position, subject to minimum of 5,000 and maximum of 1 lakh. The positions for this purpose will be valued at the underlying closing price. So the 1% how they calculate is based on the closing price. The increased position with the number of contract increased with the closing price multiplied by closing price on that 1%. The minimum penalty would be 5,000. So if you buy a single contract, you have to pay at least 5,000 as a penalty minimum, and maximum 1 lakh. So adjustment of corporate actions. The methodology to adjustment. See, this is one thing where we need to understand. It will there is no much impact on futures contract, but there is a lot of impact in options contract. The basis for any adjustment of corporate action shall be such as the value of the position of the market participants and the come and ex dates for the corporate action shall continue to remain the same as far as possible. This will facilitate retaining the relevant relative status of positions, that is in the money, at the money, and out of the money. This will also address issues related to exercise and assignments. So corporate actions to be adjusted. The corporate actions may be broadly classified under stock benefits. So we can define the corporate actions in two ways. One is a stock benefit, and a second one is cash benefit, or a monetary benefit or non-monetary benefit. The various stock benefits declared by the issuer is bonus, rights, mergers, amalgamation, splits, consolidation, warrants, and cash benefits are only, we can say, hardly the dividend. So how this is impact? The adjustment factor is one thing we need to understand. For bonus, if there is 1:1:2 ratio, adjustment factor would be A plus B by B. So if 1:2 ratio, 1 plus 2 by 2, that is 1.5. Stock splits and consolidation, A is to B is then A by B. So this is how they come with the adjustment factor. And market lot will be the new market lot shall be arrived by multiplying the old market lot with the adjustment factor. Suppose if security A's market lot is 1000 and there is a 1:2 ratio of bonus, then the multiplier is 1 plus 2 by 2, that means 1.5. So 1000 into 1.5, they will get the new market lot would be 1500. The new position shall be arrived at by multiplying the old position by the adjustment factor. So if there is any position uh, adjustment, this is the way how they will get. So the time of adjustment would be any adjustment for corporate actions would be carried out on the last day of on which a security is traded on a cum basis in the underlying equities market after the close of trading hours. Adjustment may be modified to a position or contract specifications like stocks price, strike price, position, and market lot multiplier. The adjustment would be carried out and based on the nature of the corporate action. The adjustment for corporate actions should be carried out on all open positions. So for mergers, an announcement of the record date for the merger, the exact date of the expiration, last come date would be informed to the members. After the announcement of the record date, no fresh contract on features and options would be introduced on the underlying that will cease to exist subsequent to the merger. Unexpired contracts outstanding as on the last come date would be compulsorily settled at the settlement price. The settlement price shall be the closing price of the underlying on the last come date. Until cancelled trades, orders for the futures and options contract and the underlying outstanding at the close of the business on the last come date would be cancelled by the exchange. So here there are some examples like bonus, stock split, and consolidation. The strike price. This is for the basically the options. The strike price, new strike price shall be arrived by dividing the old strike price by the adjustment factor. And market lot, the new market lot shall be arrived by multiplying the old market lot by the adjusting factor. Position, the new position shall be arrived by multiplying the old position by the adjustment factor. So adjustment factor plays a key role. The For the dividends, here dividends are cash benefits. The concept here is dividends which are below 5% of the market value of the underlying stock, not face value. The market value of the underlying stock would be deemed to be ordinary dividends. Suppose if security is trading at 1000, 50 rupees dividend on that security is per share is below is 5%. So below 5% they will treat as normal dividends and no adjustment in strike price would be made for ordinary dividends. For extraordinary dividends which are at and above 5% of the market value of the underlying security, the strike price would be adjusted. So if a stock is trading at 1000, 50 rupees or above, which is 5% or above, they will treat as extraordinary dividends and the strike price will be adjusted based on the extraordinary dividends. To decide whether the dividend is extraordinary or at the above 5% of the market price of the underlying, the market price would mean the closing price of the scrip on the day previous to the date on which the announcement of the dividend is made by the company after the meeting of the board of directors. However, in cases where the announcement of dividend is made after closing market hours, the same day's closing price would be taken as the market price. Further, if the shareholders of the company in the AGM change the rate of dividend declared by the board of directors, then to decide whether the dividend is extraordinary or not would be based on the rate of dividend communicated to the exchange after AGM and the closing price of the security on the day previous to the date of the AGM. So this is how they consider the closing price. In case of declaration of the extraordinary dividend by any company, the total dividend amount would be reduced from all the strike prices of the option contract on that stock. The revised strike price would be applicable for the ex-dividend date specified by the exchange. So these are the uh, basically these will impact on option strike price. So there is no much impact in futures. So closing out of the future contract. So basically there are three ways to close. After establishing a future position, the primary decision you will make is the investor will make is when to close the position. To close an open position, one can take the opposite position in the same future contract which they are currently holding. And traders will generally close positions for three main reasons. The profit targets have been reached and the trade is exited at a profit. Stops levels have been reached and the trade is exited at a loss. Stop orders executed, so we have to come out of those trade. Obviously, once we update the stop loss, the price is against our trade, then it will hit the stop loss and they'll come out of the trade. Trade needs to be exited to satisfy margin requirement. Suppose if we enter a nifty trade and it's fallen, so to adjust the margin requirement, we have to either deposit the cash or collateral, or you can exit from the position. So the three ways of closing future point: delivery or cash settlement, offset or reversing trade, exchange for physical or transactions. So delivery: most commodity futures contracts are written for a completion of the future contract through a physical delivery of a particular good. Cash settlement: that is how in a exchanges the equity and index futures are settling through cash. Most financial futures contract allow completion through cash settlements. In cash settlement, traders make payments at the expiration of the contracts to settle any gains or losses instead of making physical delivery. So most buyers and sellers of future contracts do not actually make or take delivery of the underlying asset. One can close the position anytime before contract expiration date. So these are in live trading. You can close at any point of day. Even intraday, we can buy and sell. So offset or close out their positions in the future market by the settlement date. Trade the same contract at maturity month to open and close the position. So if we are on the long side of Nifty March future contract, you can sell the Nifty future contract, March contract to close out the position. Obligations not net out when traders close. So after establishing future position, the primary decision is when to close. That is what. So these are the three main reasons why a person will close a future contracts. So exiting a rising position, one way to exit a position is by placing an exit order that will trigger automatically when price reach a predetermined target using a limit order. Suppose assume a trader has purchased two Nifty future 2019 contracts at Nifty February futures at around 10,650. If the trader places an order to exit the Nifty futures February futures at around 10,700, that is 50 rupees profit, an order will generate it automatically to sell if price moves to this level. So once it is 10,700 level, it will automatically close out. Another option is for the trader to decide to watch the market and place an order in the real time as the market is moving. So one can put a predefined sell trade, or they can wait and watch till it reach their expected profit levels. If there is still a strength in that stock after reaching a initial target, then they can use the trailing stop loss to gain more out of their trade. So in both scenarios, the trader is selling to close their long positions for profit, but may have different outcomes based on the exit strategy they implement to close the trade. So each exit strategy has a consideration that affect the outcome of the trade. So the advantage to placing a closing order is in advance is that the trader does not have to be at their computer for the order to fill. So if they decide the exit order in advance, they need not watch continuously to check the prices. They can system automatically will take care of the position. So the closing of positions when there is a margin call. Another reason for a closing position is that the trader receives a margin call and must close out their trade regardless of the market price. Brokers will either notify their client to automatically liquidate the trader's position to free up the account margin. So each broker is having a right to close out the position if the investor is not responding to their calls. When traders close a future position for the profit, their account balance will increase. If the trader closed the future position for loss, the funds are withdrawn from the trader's account and their account balance will go down. So in the first scenario, there are three scenarios. In the first scenario, the balance will increase because the position is in profit and they will be benefited out of that. And the second scenario, stop loss hit, then he will be in loss and his balance will decrease. And even margin requirement, if the trader is closing out the position because of margin requirement, his balance will decrease. So these are the scenarios when a position is closing. Accounting for futures. I have taken an example of Nifty contract. Suppose trade date is January 7th, 2019, and underlying is Nifty purchase and long contracts. Contract price is 10,885, and closing price is 10,803.45 price. So here the multiplier, that is lot size, is 75. Expiration date is 31st January 2019. The notional amount here we calculate notional amount. Notional amount is contract price, number of contracts, and the lot size. The multiplication of trade price, lot size, and multiple number of lots. So here 10 contracts, price is 10,885, multiplier is 75. 75 is the lot size. So 81,63,750 is the notional amount of that contract, the trade. So here the accounting, in the event of any gain, it will debit it to variation margin, credited to unrealized gain or features. So here there is a loss. So for loss, unrealized gain or features is debited to and credited to variation margin. So here there is a loss of 61,000 because if you see the contract, long contract entry price 10,885, closing price is 10,803. So there is a loss. 61,160 rupees 50 paisa is the lot. The closing price and the trading price difference. This is the first day of trading. So closing price and the entry price difference multiplied by the number of contracts and lot size. So in the second example, on 1st January, the 2nd January, investor A purchased 31st January Nifty future contract. So here the one is the contract number, January 31st 2019 is the expiry date, and trade date is January 2nd 2019. The quoted market price at the date of purchase is 10,900 per unit. Each contract covers 75 units, so 75 is the lot size. The initial margin deposit 84,000. The margin requirement is 84,000. At the end of day one, the settlement price of Nifty contract is 10,830.85. This is the closing price on the day one. That contract is closed on January 3rd 2019 when the quoted market price is at 10,750. So on the next day, Nifty closed at 10,750. This is the example. So trade date 2nd January, one lot January futures, Nifty futures. Trade price, buy price 10,900. Margin requirement 84,000. First day closing price 10,830.85. Next day closing price 10,750. So these are the details. Here the initial deposit of the future broker 84,000. That is this is to record the initial margin deposit when the contract is executed. And trading day closing loss 5,186 because 10,900 minus 10,830 spot 85. So 69 rupees 15 paisa is the loss per share into 75 is the lot size. So 5,186.25 paisa is the loss. See, this entry is for initial margin payment. This is to recognize the loss on future contract. So 69 rupees 15 paisa. 10,900 is trading price. First day closing price is 10,830.85 and one lot of 75 units. So 5,186.25 is the loss. Loss on futures, debit to loss on future contract and credit payable to future broker. So this is payable to the future broker by the investor. So when the contract is closed on January 3rd, so contract is closed at 10,750 and close. So payable to future broker, this is the loss on first day. So needs to pay for T plus 1 and loss on future contract on second day. So previous day closing is 10,830 and January 3rd closing is 10,750. The second day loss is another 6,063.75 paise. So first day loss is 5,186. It is payable to the broker. Second day loss is 6,063.75 paise. So total loss is total needs to be settled to cash settlement, that is 11,250. And on the last day, as it is closed out, the initial margin amount, whatever deposit to the broker, that will be reversed. So here deposit with the future broker is debited and cash is credited, and the closing of the position, cash is debited and deposit with the future broker is credited. That is how the accounting will happen. So overall 84,000 minus 11,250 will be loss. His balance would be 72,750 would be the balance in the client investor account after this transaction. So these are the entries we need to understand. So thank you for watching this video. I think I have clarified my majority of the concepts here I have discussed. If there is any questions, please post in the channel itself so that I'll reply to your questions. I request to subscribe to the channel so that in future if anything I uploaded into the channel, you will get a notification. Please post your comments, feedback, so that will help me to understand your requirements and work more on that. Thank you very much.